Hello everyone, welcome back. In my last video, I went over how to treat a loyalty program under IFRS 15. In this video, I will go over how to treat it under ASPE revenue recognition criteria and the differences that apply. In accordance with ASPE, revenue from sale of goods or services is recognized when performance is achieved, provided that at the time of performance, ultimate collection is reasonably assured. Similarly to IFRS 15, ASPE revenue is focused on the timing of promises or performance. It is necessary to apply the revenue recognition criteria to the separately identifiable components of a single transaction in order to reflect the substance. Specific criteria to assess performance will vary depending on if the transaction is for the sale of goods or services, but the three criteria must be met to record revenue. That is, performance must be achieved, the amount must be reliably measured, and collection must be reasonably assured. A tip to remembering this is to use the RCMP method. Now let's review the example used in the IFRS video. Company ABC is a new startup company that sells shoes. They've created a new loyalty program in an attempt to boost sales. For every $1 worth of shoe purchases, the customer receives 1 loyalty point. These points can be spent on future purchases at company ABC, and each loyalty point is worth 10 cents of ABC purchases. A historical trend of similar companies in the industry have indicated that company ABC can expect 95% of these loyalty points to be redeemed. As of May, the company has sold $1,000 worth of purchases, and no liability has been set up thus far. Before we begin assessing the revenue recognition criteria, we must assess if the transaction of selling shoes and loyalty points are separately identifiable components or not. If they are, we will have to assess the revenue recognition criteria for each of these components. A component is separate if the following 2 conditions are met. The first is that it has a standalone value. In other words, it can be sold separately. In this case, this is not met as company ABC does not sell loyalty points on a separate basis, and the customers can only acquire them with the purchase of shoes. The second is the fair value of the component can be objectively measured. While the shoes have a fair market value that can be measured as the price for which the customer pays, the loyalty points are considered to be unique to company ABC. While we can measure them at 10 cents per point, this is not representative of a market value. Because both conditions are not met, the sale of shoes and the loyalty points earned are not considered to be separate identifiable components, and therefore revenue recognition will need to be assessed together. Now let's begin to assess performance. It is important to note that while IFRS 15 was based on control, ASPE is based on a risk and rewards model. Because this is representative of a sale of goods in this transaction, we will assess the goods performance criteria, considering how this transaction has multiple deliverables. For performance to be achieved, several indicators need to be met. The first is that the risk and rewards of ownership are transferred. Some indicators of this are that all significant acts have been completed, the seller does not maintain continuing managerial involvement or control of the goods, and that the possession and the title have passed on. In this case, when the shoes are acquired by the customer, these criteria are met. However, this is only met for the loyalty points when the customer redeems the points or they expire. Continuing on with performance, persuasive evidence of an arrangement must exist. This is met as company ABC has agreed to provide the customer with shoes and loyalty points at the time of the purchase, and the customer has agreed to provide company ABC with money. Delivery must also have occurred. This is met when the shoes have transferred to the customer at the point of sale. However, this is not met for the loyalty points yet, as this is only delivered to the customer when they redeem the points at a future date. Lastly, the seller's price to the buyer is fixed and determinable. This is met as the price is determined when the customer orders the shoes and will not change. Therefore, at the time of purchase in May, performance of the shoes is met, while performance of the liability points are not yet met. Because company ABC has an obligation to provide rewards to the customers that have earned them, this should trigger the need to assess whether a liability exists and should be recorded. Under ASPE, a liability is met if the following conditions are met. This includes obligations arising from past transactions or events, Settlements may result in transfer or use of assets and provision of services or other yielding of future economic benefits. In this case, the obligating event of the initial purchase is a past event, and the settlement of the points upon redemption in the future at a discount is a transfer of assets that will also have future economic benefits to company ABC. Therefore, the conditions are met and a liability for the loyalty points should be determined. Since the customer earns 1 loyalty point for each dollar spent, we must estimate the amount of points that are outstanding at the end of the period. Given that $1,000 worth of sales have occurred, approximately 1,000 points are outstanding. To determine the amount of liability that should be accrued, the points need to be valued. Since 1 loyalty point is redeemable for 10 cents worth of purchases, it can be estimated that company ABC's cost will be approximately $100. Factoring in the likelihood of the points being redeemed at 95%, a more accurate estimate for the liability would be $95. As the points are redeemed, the liability will be reduced and revenue is generated. The liability will also be reduced when the options for these points expire. The other revenue criteria that needs to be met includes measurability and ultimate collection being reasonably assured. These are both met as shoe revenue is determined and measured at the point of the sale, which can then be used to estimate the loyalty points. There is also no indication of any collection issues in this case. For further guidance on ASPE liabilities and revenue, check out sections 1000, 3290, and 3400. Now you're ready to practice loyalty programs under ASPE and IFRS reporting financial responsibilities.